Okay, so I'm so excited about this Carson corner. Let's come Carson's
You usually are.
predictions.
I know you're such a huge fan.
Well, I used to like discount what he was saying because I didn't understand where he was getting his information. He used to be a market maker, and he did that for years. And he understands the options. He understands these markets. He understands positioning a lot. That's his big thing. And I was like, no, I want big macro plays. I want a big, fundamental moves, and I want to, bet on the. Those are the types of bets I made money on, and I didn't want anything else. But when I'm wrong, or when you're wrong in that sort of framework, you're very wrong, and you don't even know why you're wrong. You're just making some guess, even if it's an educated guess. And if piece of information changes, and you have this confirmation bias, and you don't adjust to it, then you get this, you get it rubbed into your face. But Carson doesn't have that problem because he'll say both paths. He'll say this is the bullish case or the bearish case. This is the path that I think it'll take. And if I'm wrong anywhere along the way, well, then my thing is invalidated. So there's no worry about that. So I just wanted to pull up a tweet from a Kobisi Letter, a Twitter account that I follow, and then I want to jump to that video because his last interview on Schwab Network I thought was absolutely fantastic. So let's take a look at this tweet first. So this is about the recent rise in Treasury yields that has been truly historic. The 10-year note has risen 115 basis points since rate cuts began on September 18th. This is the first such occurrence over the last 40 years, covering 11 cutting cycles. In the previous 10 cycles, the 10-year note yield declined by an average of 103 basis points after the first rate cut. In other words, the market is now moving in the exact opposite direction as the Fed. The January 29th Fed meeting will be interesting. So we're seeing here, just mapped on to the same sort of scale, that the rates that we have in the 10-year now, the long-dated rates, have moved, not just up, just insanely up, completely not in line with the last 10 cycles that we've seen. Why is this important, right? So the yield's going up. This is inflation potentially on the rise. So I've been, talking about the idea that I think we're going to get to, 11 to 15% inflation over the next couple of years. I'm expecting that other shoe to drop. And Kim Carson actually goes into some nice detail as to why. So let me just pull up that video.
Right before that, the market closed the gap from the Trump election. Right at the time when Mr. Jem Carson, a regular here on the Schwab Network, suggested they might. He's a senior managing partner, Kai Volatility Advisors. How you doing, Jim? Good to see you.
Good to be back. Good to see you.
I feel like you're probably riding pretty high right now because we got a few things you were looking for. The yield got close to 5. We got the 10-year to 4.8, which is one of your predictions from last year. And then you had a pretty nicely timed tweet that basically said the election gap would close essentially the day it did. Which of those matters more here? How do they fit together?
Oh, well, the gap.
So here the chart for the SPY, when it broke out on the after the election, he said, this is back on November 29th, he said that the SPY would come back down to where it was before the election by January 13th. And on January 13th, that's when it completed its retrace and it bounced from there.
Gap close was, that was going to happen eventually here in January 13th. We got it right to the day. That felt good. But the bigger deal is yields. Yeah. The bigger question is where are they going next? And, just like we called for 5 when we're sitting at 3, we're calling for 6.25, 6.5 here now this year. That's going to be a very interesting move. I think it'll happen gradually. I don't think it's about to take off there. We could digest, pull back a little bit even before that. But I do think we hit that, in Q3 probably, not even by the end of the year. And I think that starts a bigger decline that I do see coming out on the horizon. That's at least one of 2 paths that are really sticking out to me at this point.
Can you help me understand in a brief diversion, because we got other stuff we're going to hit too, but maybe what Waller's thinking when he sees 4 cuts this year? I mean, didn't we just realize in the last 3 months that cutting when GDP is 3% kind of makes the bond market do wild things?
Yeah.
So this is something you've been talking about too, Mike, that we've been pointing out that the economy, the numbers for how well the economy is doing in the United States aren't bad.
Right.
Like whatever you might say about how the numbers are calculated, they aren't bad. And so why is the Fed cutting like it's cutting? And it's cutting in the face of whenever it cuts, the 10-year yield keeps going up. And so he's calling for it to go to 6% or 6.25. by June, July, August of this year, which is crazy where it is right now. It would be completely different than what the Fed is trying to do.
Yeah, I think it's signaling that the bond market has a different opinion than the Fed does. They're expecting inflation or versions of volatility that they need to hedge against. They need that risk premium reduced. They need to move some of this into the bond market. And so I saw the same thing as well. One of the indicators that I try to pay attention to is the spread between the BAA bonds versus the 10-year, and even that just shot up pretty significantly even as of today. So as credit spreads rise, I think it's clearly indicating from those bond markets that they're expecting volatility on the horizon.
That's right.
Yeah, I think the Fed is pretty much understands that the market is everything. And it's not about whether they're going to cut or not. It's about the narrative and supporting markets through this period. Especially coming into the spring, it's well understood if they can keep a cap on interest rates early. That's why like last December, they were also surprised. Everybody was surprised at how much they were really trying to put out that they were lowering rates. The structural effects in the economy are very tied to that spring. So if they can do that early, that's really good for the market and the economy. But they have to get out in front of it. And if they don't, weakness begets weakness. And they really don't want to see a week move into March here, which I think is very possible if they're not accommodative right here. They don't want to see that 10-year yield creep higher from here. Weakness, and remember, it's a $100 trillion equity market. If you got a 10%, 20% pullback, that really starts to affect the economy. The market leads the economy, and that liquidity will then need to be countered, and it'll probably be too late at that point.
Okay.
So I think they're really trying to be proactive, particularly at the end of the year they were doing it. They're trying to show that any chance they have that they can do that, they are going to do that.
Do you think that over the last 3 months, that move from September into the 4.8 for the 10-year, was that because they were cutting? Because then we get into a tricky spot where if they try and help the market by talking too dovish, then
actually spot on.
Rates will keep going up, right? If you think that was the causality.
We talked about that here. I mean, you may remember 6 months ago.
And I'm convinced it was the causality.
Yeah, when we talked about why will this go to 5, you're like, whoa, 5, how, really? That's a big call. Remember, the reason was because they're going to be aggressive in cutting, which is structurally inflationary. And to be clear, if they are accommodative here, the market will hang in and we won't have that decline yet. And instead, we'll get a blow off top.
Okay.
They are trying to keep the plate spinning. But these yields cannot keep going where they are going. And this be sustainable. It's not. Yields can't go to 7, 7.5, which they will go to be clear, if they are as accommodating as they said.
Okay, so what they really...
So just to, I mean, that to me is just so terrifying. So just to make it clear for everybody, the idea here is that the Fed, previously we've been used to a deflationary environment with rates down 0 or near 0. And the idea is that the Fed was cutting in order to be stimulative, in order to try to get inflation up, because yields were kept being pushed down naturally through the deflationary effect. Now we're in the opposite scenario, where the yields are rising and they don't need to cut in order to juice anything. The yields are rising, and that should be an indication to the Fed. Well, stop cutting rates. The yields are fine. Just leave the rates yields where they are. Now, long-term yields, when they're above the short-dated yields, in general, can be considered healthy. You expect shorter dated yields to be lower than longer dated ones. But if the longer dated ones keep on rising, then it's inflationary expectations. It's inflation expectations. So the markets the reports are coming out and saying, well, we're not really having any problems right now in the markets to justify your cutting. Yields are going up, well, your cutting right now is going to generate higher stock market. So asset prices will go up in value. That will have this wealth effect where more people will have money in their pocket to spend because they'll have the higher stock markets get to sell it in order to spend, or they have more collateral in order to invest. So that's going to generate trillions of dollars of more money within the system, which will be inflationary in the future. So the bond market's like, hey, relax. And what Cam is saying over here, and what the interviewer was asking is are the rate cuts causing the yields going up? Which, I mean, that he wouldn't even ask that question and go, of course, that's what's happening. Of course, them cutting the rates is causing yields go. You're even asking? That should be everyone should understand that. But there's tons of people who don't know that, even in the Fintwood space, who don't understand that it's tied together. And so it looks like if they are accommodative, and like he was saying, the Fed wants to keep the markets up. If they're accommodative now, let's say as of the January 29th meeting, then he's expecting a blow off top in equities, blast off in yields, and then what happens when yields are at 6-7%? well, then people go, well, I don't need to risk my money in the stock market. I could just move to bonds.
Yep.
And then you have a crash.
So all that's true. I think to be fair to the Fed, at least in terms of what we're expecting on January 29th, the futures market is already pricing in a 99.5% chance that they're going to continue to pause. So at this point, I don't think continued cuts are on the horizon yet, not even for March. If we look forward to March, the March futures market, there's about a 71.6% chance that we'll still be at a pause. So we wouldn't see rate cuts till potentially May of this year at the meeting in May.
Yeah, so Cam is about to talk right now about the dangers of a pause. So if they were to be dovish, let's say, well, I don't want to step on his heels. Let me just play what he's saying, and then I'll come back on the other side.
Sure.
You're doing is talking what, like tamping things down?
I mean, it's a dangerous act at this point. Valuations are really high, right? Liquidity. There's some liquidity issues coming on the table. We have a new administration, all kinds of potential risks, right? But imagine now that they don't do anything and they're behind the curve. So they're trying to do the lesser of two evils, I think, and project that they're cutting. But that's ultimately going to drive yields higher. It will probably drive the market higher if they're really aggressive, and then really get a blow-off event, which will be worse. They're actually provoking volatility, not compressing it, in my opinion. But it's a balancing act, and I really feel like if they don't do it now, we're going to get a decline sooner. And I do think it'll be a big one, 30 to 40%, if they don't start cutting and projecting monetary policy here early.
This sounds like a bit of a more kind of a macro-driven kind of volcanic type of event that you're describing than I think a lot of our conversations, which are these kind of periodic moments of weakness, windows of opportunity for weakness. It sounds like you really think that the pot might be boiling over in a way here this year. Is that fair?
It's a function of timelines, right? When we talk flows and macro, we're generally talking weeks, months, maybe a quarter if it's a big end of the year thing like we talked about. When we start talking about years, that's when the big picture stuff matters, right? And so yes, it is a bigger picture. We talked in detail about the election years and how over all the populist elections were an average of 21% up, right? And that all of them were positive double digits. And if you pulled out those election years, the election years were 5%. That 68 to 82 period, 14 years, went nowhere. If you pull those out, negative 10 per year in real terms, over 70% loss. Those are big macro picture things. That's a function of liquidity during populist election cycles and what happens afterwards. Guess what? We're no longer in an election year. 68, 69, very similar type of setup. Go take a look. You get a very, very positive election year. New president and Nixon, who in a lot of ways mimics Trump in a bigger picture way. For the first 6 months, things are okay, kind of chopped around. Remember, tops are processes. Bottoms are events.
Okay.
So this, I believe, unless the Fed gets involved early and changes the trajectory of this, is a topping process for events.
And they would have to do that by sounding more hawkish.
No, actually, they would. If they are dovish now, they will extend the story. They will get more of a blow off top.
Right.
And then the decline will come.
Right.
It'll just come with higher yields a bit later. So 6 months, a year later. We're not talking about years later, right? So this is a function of path, right? We know the destination in terms of macro. Okay. The question is, what are they going to do with liquidity to change that path?
Okay.
And if they're trying to keep the plate spinning, which they're prone to do, new administration probably pressuring the Fed as well.
Yeah.
Right. If they go that path, then you likely won't get the decline yet,
right?
Because those flows will act in the short term to support.
You're building the tinder for a big fire.
Squeezing the shorts, you push the thing up. It's a volatile market up volatile, not for a day or a week, for months. Think 98, 99, right? These are big rally years that ultimately are undone, right? But the path is different because of liquidity. Greenspan changed the game there and led to a bubble. It wasn't the irrational exuberance; it was the liquidity, right? And so if they decide to pump liquidity, we will get a blow off top.
Sure.
And
so this is the part I find interesting. So the markets are pricing in a pause, but if the Fed is seeing, as we've been seeing, a pullback in liquidity, we've been seeing a pullback in liquidity for a while now, and they know that if they don't sustain it, there's a chance for a market correction. The administration might not want that, and they might buck the expectations and go ahead with a rate cut. But either way, what Kem is saying over here is that either way, we're going to get the decline in the market. He's expecting 30 to 40%, and within this year, whether that's Q3 or Q4, it depends on what the Fed is. It could happen in March if they pause, and if they don't pause, we got to blow off top, and then it happens in Q3, Q4. That to me is like exciting in the way of, look, if a car crash is going to happen, I'd rather know ahead of time, sort of idea. the whole idea here is that we're trying to profit from these events, and we've been tracking this pullback in liquidity. We've been talking about, hey, Bitcoin's rising, but we're not getting the corresponding thing in liquidity. Assets, we got to an all-time high on the SPY with a 6,100, but it didn't blow off like the way Bitcoin is doing. What's happening here?
Mm-hmm.
There's a liquidity issue here, not just the United States, but throughout the world. So it's a non-zero chance that the Fed, at least, let's say they don't cut, they might guide towards cutting, and they might introduce other types. They might reduce a quantitative tightening in other areas that tantamount equates to adding more liquidity through a rate cut. And if that happens, if that's what we're seeing in January 29th, calls, baby, calls on the SPY.
Sure. So I'm with you. I think he had also mentioned at one point earlier in the interview there that valuations are high, and that is definitely one area that I can completely agree with. We've covered that a few times on the show here, where Shiller PE is placing the average S&P 500 component at roughly 38 price to earnings. And in the past, when we've seen price to earnings that high, that usually is accompanied with some pretty big reversals in markets. We saw that with the dot-com crash, with the GFC. We saw it in the 1970s as well. So there's certainly a case to be made that the market's looking pretty expensive at the moment.
That's right. I've actually always had a difficulty in responding to that because you've been right that a lot of these markets are overvalued, but I've never been able to understand when it matters. Right.
That's the thing. I think what it does is it heightens my attention on pullback events. Right. I want to see if I start seeing breaks of recent lows, we start establishing new lows and lower highs, and then we start forming this trend to the downside. That's when we want to pay attention. We kind of almost saw that recently with the S&P. As we made a new low, we've bounced up a bit, which, if I can share my screen here, this still has me a little bit concerned that we're already in the beginnings of what this trend could be. Right now, this current high in this recent little uptrend is still a lower high. So we'll have to see how next week shakes out. If we can continue to retest the high and continue into a new zone, then maybe I'm not so concerned. But this recent pullback represents the breaks of lows and established lower highs that generally concern me about the reversal of a trend.
Interesting. Yeah. So this is what he was saying. Tops are a process. So you get this, essentially this longer dated pivot. And if we don't break the new highs, that's scary to the downside.
Mm-hmm.
I just want to finish off this last part here where he talks about these two different paths, because I think they're very interesting, and I suspect we're going to be referring to them on future episodes. Let me just pull that up.
It will be volatile, and it will be long vol, right? That will not end well, and it will not be years, by the way. It will be maybe another year. But the picture from a macro perspective is not good, and the market leads the economy. So if we start to get a decline, we will also have a recession in Q3, Q4, which does not look like it now, but it will come on the back of a market decline. And so the question is, what is the Fed going to do? Are they going to be actually accommodative, dovish early, and try and keep the plate spinning and force a real liquidity push into a short, market that will be able to squeeze the shorts into high valuations? Or are they going to wait, see what happens, and then be too late?
Okay.
And then catch a declining market into stair steps, which again I think will be 30.
Would that be
40%? I'm talking like a 30 to 40% decline by next year if they don't do that.
Okay, so if they don't, to be clear on that point, because the question about whether or not they could stop setting the tender for the explosive fire by being more hawkish relates to that point, which is, are you saying that either way there's going to be that type of event basically at mid-year? Because it sounds like, one, if they're too dovish, they're setting the tender for the burn.
The timing
changes. Okay.
That's exactly.
If they're more patient or hawkish, if you will.
To be clear, if they are dovish, we get a bigger, faster move up.
Right.
And it probably doesn't end until September or January of next year.
Okay.
If they are not, if they are, let's wait and see, in front of inflation, right? I think we get a decline and force their hand. But I think amidst that decline, it'll be too late.
Okay.
Because the amount of liquidity, again, you have to understand to a year. And there really are, I want to be clear, people are going to say, well, you're calling up or down. Thanks a lot.
So this is the trade, what his trade is. We're going to end with this.
To a year. And there really are, I want to be clear, people are going to say, well, you're calling up or down. Thanks a lot. The reality is there's 1,000 paths. I'm giving you 2.
Right.
I'm giving you 2 paths in time and speed and direction. And a big move up would end up at 6,600. Okay? That's the type of move you're getting a year. Mm-hmm. And if not, we're going 30 to 40% down. This is not a sideways market. This is a volatile market coming. Prepare for it accordingly. Long-dated calls, I've talked about this before, are way too cheap. We're talking about a 10.5 vol.
Okay.
It's insane. You should be, we've said this before, they've been very lucrative by doing this. Own those, be short stock against it, because if the rally comes, you're getting volatility upside, you're getting leverage to the upside. Those will perform into a rally. And if we decline, you're short stock, and those things are cheap.
Okay. Do we put on the bond shorts now?
Yeah, so that's always my favorite type of analysis. My favorite type of analysis is, how do I place a trade so that I can benefit either way?
Right.
That to me is like, okay, you're actually clever.
Sure. And, when I saw that trade earlier in our notes here for the show, it actually, kind of was interesting to see a sort of the inverse of my typical trade. Typically, I would just be long stocks only, always remain long and hedge through deep out of the money puts or other short instruments. Maybe I'll have some exposure in futures, but he's describing the inverse of this trade. So effectively staying long calls because they're so inexpensive right now, and the cost of that risk is so low, you can just let those options expire worthless if you're wrong. And then just go short the market from there, which is a really interesting express trade, right? Because you're expecting that there could be this blow off, but your overall general consensus is that the market is going to pull back. You just don't know when it's going to happen, and you don't want to risk being in a short position without some hedge to the upside in case there is some kind of blow off over the next year.
That's right. And the hedge to the upside that you have here is asymmetrical. It's a convex payout structure. And so you get more than if you were just going to hold the stocks over that period of time. Now, you do have the downside of, if the market falls beforehand, you lose that premium, or if he's wrong and it does go sideways, then you don't profit either way. Actually, you lose money carrying the trade. But that's I'd rather that outcome than the other outcome.
Well, I think he's more than confident that there's going to be some volatility this year, and especially early in 2026. I wouldn't disagree. I think that there's definitely a strong chance of that, especially as we sort of near the end of this potential bull run that we've been on for a while. And admittedly, I think many people have been expecting this pullback for a while now, about 18 months. So it's a little overdue at this point.
If you're Peter Schiff, you've been expecting for 20 years. But what I wanted to show here is on my chart. So he talked about the 30% draw, or 30 to 40% drawdown in the SPY. Just to pull up something, I always take a look at this. So one of the reasons I always have these, let me just remove some of the clutter. Okay, so one of the reasons I have these levels on my chart is that we always somehow get down to these areas. We always get into these zones. So this pink and orange zone. And so for the 30% drop down from over here is exactly where I would expect an event brings us. A negative event brings us. If it's news or a geopolitical event or whatever, a catalyst that occurs during a window of weakness, blah, blah, blah. And so it's not one of those things where necessarily you can place your bet for that short like when the event happens, right? These sorts of things that happen. This is the COVID crash. This is Volmageddon. This is the pullback that we had when inflation was starting. These events, it's hard to get in, especially with options when they already started, because the moves are so short. You know the Fed's going to come in to the rescue. It's sort of hard to profit when it's already happened. And so having this short position on with the call structure up, as the market moves up, you're actually gaining more than the loss of the straight short. Because I think here the shorts for the stocks, he's not saying puts. He's saying literally short the stock out.
Short the stock, right?
Yeah. And so you don't get the same danger. But that drop over here is also reminding me that we didn't actually get. Let's go to Bitcoin. In Bitcoin, we didn't get a 30% pullback. The regular 30% pullbacks that we get in Bitcoin just regularly, it happens as a matter of course. And I thought we would get it somewhere around here, right? That
We
would
haven't
have
yet.
pulled us.
Yeah.
Yeah, that would have brought us to the $75,000 range we've been talking about.
Right.
And the fact that we didn't get there, that to me is actually problematic, because you want price to come. From my perspective, you want price to head down into these zones to clear out the shorts and grab your orders, right? Grab your orders from these levels, and then you can move up with ease. Same thing would happen here. I don't know if you remember, we had one of these episodes where I said this zone over here is going to coincide with this area coming up, and that area coming up is where we'll get the orders, and then we actually moved up from over there.
Yep.
And so if we're not getting that, this now we're in rarefied air, and we would expect some significant pullback. And it doesn't matter how high we go, we got to get to one of these levels. We got to get down there. That's how I see it.
I agree. I think I'm a big believer in healthy corrections. I'm a big believer in the cycles that markets tend to go through, and for all the obvious reasons we're describing. There's profit taking. There's short sellers that have exhausted their positions. There's going to be a move to the downside if the bears obviously overtake the bulls at some point. This is a pretty predominant thing that you notice in any kind of asset class. So it can't go up forever is the point, and especially over the longer term trends. It can't go up forever. We're going to have a healthy correction at some point.
That's right. So to summarize my thing for the 2 points there, one, I do believe that the case for Bitcoin to $1 million to me now seems more believable than I felt from 10,000 to 100,000. And also, I have no FOMO for any of the levels here, because I do expect, like, I'm
Some
fine
kind of
with waiting for
pullback.
the next, exactly.
Sure.
And I don't care how high it goes. I don't think there's a scenario that this goes to 250,000 and then it never pulls back, and it was just like it's going to pull back.
All right.
And we're in the percentage gains here, so who cares if it falls from 100,000? Who cares if it goes to 200,000, falls to 100,000? Makes no difference if I'm going to make a 100% gain or whatever on the trade.
Sure.
All right, so leave it there. Is there anything else you're looking at in the markets before we go?
These were the highlights for sure.
That's right.
I'm always secretly looking at individual securities, of course, but that's another show for another day.
Exactly. We're gonna have we're gonna pick apart, if there's anything to pick apart for the Trump inauguration. If we can see if there's any trades that come out of that, I'm gonna be glued to my charts on Monday, taking a look at that. But until then, we'll see you guys next Friday for After Hours.